Give me 1 second. 3, 2, 1.
This is episode 33 of the New Barbarians podcast. Today is Wednesday, August 20th, 2025. The podcast will hit the platforms later today. Today's guest is Michael Nadeau. Is that Nadeau or
Nadeau?
Nadeau. Founder of the DeFi Report and Web3 strategist. He will share his journey, advice for innovators, and trends shaping asset tokenization, venture capital, and AI convergence. And I'll just quickly talk about quantitative factor performance recently. The market was focused on the inflation report last week as Trump continues calling for a rate cut. Headline inflation remained the same, while core inflation increased to 3.1% year over year, further complicating the Fed's monetary policy decision in December. However, despite the increase in inflation, interest rate futures, at least last week, we're still pricing in a 92% chance of a rate cut at the next meeting in September. GDP growth in Europe was basically zero quarter over quarter. So, in Europe, at least, investors are moving into value.
Bill, can you give us a little bit of Animal House quote 0? Or was it 0.0?
It was 0.1%.
So it was better than Blutarski's GPA before he was finally kicked out of Faber College.
It was. And yeah, I guess we can't really make fun of people's physical disposition, but there was another quote about him being fat, dumb.
Fat, drunk, and stupid is no way to go through life, son.
Yeah.
So, we'll go back to why we bring these quotes up, Michael, later. They're all part of our cultural narrative, how things are distracting us from the truth, which is on-chain data, fundamental data, and the sleuthing you do is what cuts through the noise. But yes, we do go back to old movies for truth from time to time. Sorry, Bill, to interrupt you.
No, it's fine. And of course, we didn't give up when the Germans bombed Pearl Harbor.
We did not.
So yeah, the earnings yield factor rallied a bit. It was up over 2 sigma last week with a value rally. And then it looks like that's continuing in the US, but nothing too significant. A couple of 2 standard deviation moves with value rallying in the US as well. So it's a bit of a risk off, at least in terms of factors. Sensitivity to oil price was down with crude falling nearly 1%. Size and momentum also down, but that's not even statistically significant in terms of factor movements. So not a whole lot to report here, other than we still expect monetary policy to be a good backdrop for risk assets. So, Mark, I'm sure you can elaborate more on that concept.
Sure. Well, now, and Michael might touch on this too. We have this second annual digital asset symposium out in Jackson Hole, Wyoming. At the same time, we have the traditional, familiar Fed one. And this year, they have 2 Fed governors attending. Last year, I was in attendance and they had none. So this whole idea about the encroachment on digital and traditional assets is alive and well in Jackson Hole, with more people going to the digital asset one. I think Scaramucci and Salt are the ones, and Kraken who do that one. But let's go share a screen, talk some numbers. It's along the lines of what Bill just mentioned. I'm going to share a screen, which I've learned to do when I use Chrome, as opposed to the one that they don't want me to use. So let me know, folks, if you see this. Very good.
Good.
Excellent. So we call this a scorecard, Michael, and it's just since there's $900 trillion of investable assets in the world, and a little, maybe half of them are financial assets, you're looking at the majority of that right here with equities, bonds, oil, gold, and of course, Bitcoin and the dollar, just for good measure. And as Bill was saying, crude dropped a bit here. So crude's at a 12% year-to-date loss. Gold at the highest, up 27% year-to-date. And lovely Bitcoin at 26%. And then we're going to say it again, Bill, because it's worthwhile, because Ray Dalio mentioned it. He said you should be in non-US equities, and then he said you should be in non-US equities in local currency. And that's something that we've been talking about since Bill noticed at the beginning of the year in Q1 that all of Wall Street got equities wrong. And the reason why we see the rally in global ex-US, which is this EFA ETF here, almost tying gold and Bitcoin, is because 10% of that is from currency gains. Dollar down 10%, EU, yen to a degree, all up. So these are local currency equities, more than half. This is part of the plan, Besant and company, debasing the dollar, trying to get exports in their favor. There is a new global order going on. We think it's the biggest since Bretton Woods. Near term, we put out the Substack for this session with Michael to say it's stop, drop, and roll, which is going back to the Cold War. What you did in your classroom in case there was a bomb, you stopped, you dropped, you rolled under your desk. Well, that's what markets are doing. They stopped the assault off that April low. They're dropping a bit and they're rotating. So again, everything's a war theme now. Alaska, Putin, and Trump. Wartime finance, which is the deficit that we have. We don't even know the war we're fighting, but we are in a debt and deficit wartime-like finance ever since COVID. And that's why you're seeing a distortion here. Last time we saw something like gold leading the charge was 1973. So what you're looking at here, though, is month to date. Back to the roll. Apple and Tesla. Year to date, they're down 7% and 18%. They're leading the charge in August. It's just a rotation. We're chasing losers, monetizing winners as we wait for the Friday. I think it's 10 a.m. is what I read on your website, Michael. Is that correct?
Yep.
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 So that's where we are right now. I expect more volatility because I don't expect Apple and Tesla to continue to be a Q3 ending and Q4 leaders by the end of the year. But let's look at time series because abstractions are tough to figure out. Here's a path. Robinhood, the gamification of investments, they do it better than anybody. They're down. We'll show you what they are down the month. Circle, the opportunity of stable coins, reverses from, I think, about a 200% gain here out of the box on their IPO. And now they're up a paltry 55%. Citibank, which is the dogs of the financial Dow, if there was one, leading JP Morgan by over 1,000 basis points year to date. Rather amazing. Bitcoin up 20, ETH. So this is what's happening year to date. But look what's happening month to date. Month to date, you have the majority of these names down. Yes, ETH with a late surge up 23% on the month because of stable coins, etc. But ADA, Cardano, which was down on the year, up. Solana down on the year, up. And SPX is, kissing your sister here, up 1.6%. Not much to do about anything. NASDAQ, I think this is as of Friday, NASDAQ is now down on the year. So you're seeing all these winners lose. It's a rotation for sure. But one thing that's clear, and I think it's relevant to the conversation coming up on Jackson Hole, excuse me while that's moving, credit. So we talked about $900 trillion of financial assets, about 140 trillion is equities, 300 trillion is in bonds, both sovereign and corporate. It's the biggest financial asset outside of currencies. here's what the high yield, less investment grade spread looks like. The reason this is a great measure, because it tells you how much people are pricing the probability of default. A high yield bond, think of it like a leveraged car insurance company, not exactly your highest credit-worthy company, versus a Johnson and Johnson. I believe they're the last AAA, unless someone can tell me they are 5A right now. I forget. It's how much people are willing to pay or are paying for high yield over investment grade, or how much a high yield company has to pay to issue debt. And it's, Bill, you mentioned, statistically significant. This spread of 160 basis points is definitely in the bottom decile. In other words, even though bankruptcies are going up, people are still reaching for yield. Even at a 4% 10-year, people are reaching for yield. There is no dearth of demand for credit right now. No one's scared. So we can talk about VIX going up. We can talk about rotations and lofty premiums. But in the credit market, which is really where things go sideways, it is all clear right now. And then lastly, the reason why we think, and I think Bitcoin is going to continue to accrete interest and value, is because it's not about the price of money. Friday does not matter a lick, whether we go to 2% or 3% or remain at 4.25%, 4.5% on Fed funds, which we're not. We're going to drop. The supply of money is going to continue to go higher. It's 7.4% on average since 2020. And we increased our debt load at a 20% annualized rate since we lifted the debt ceiling on July 3rd in order to fund the one big beautiful bill. So the avalanche of money will continue. That's going to push asset prices higher, and scarce ones like Bitcoin and homes will continue to be out of the reach of many. I think that's all I had. I want to actually jump in Bill's ballpark for a second, and maybe Michael, you can touch on this as far as what factors look like, or what the ecosystem and digital assets look like, and how they've rotated. Full rotation in factors, which makes sense because factors are simply a representation of equities through another lens, and equities have rotated. Year-to-date growth and momentum, think Meta, Microsoft, Nvidia, all higher, leading the charge. In August, they bled out. And who's leading? Small caps. Who's buying small caps this year? No one until August. And then low vol also still down 6.5% in the year, up 2% on the month. So I think that's why we did the stop, drop, and roll. There's no real information here, folks. People are in a hideout until we come out of this. I still think there's going to be lack of information, more volatility. And I don't know what the signal is, and that's why we have Michael on to show us what he sees on chain and with some of his fundamental research. And with that, Michael, love to have you jump in, introduce yourself, and then tell us what's what and what people should be looking at on your DeFi report.
Yeah, no, great to be here, Mark. Appreciate it. Nice to meet you, Bill. Michael Nadeau, founder of the DeFi Report. We do on-chain data, deep fundamental research for crypto networks, crypto protocols, applications, and we were one of the first, I think. We kind of started on LinkedIn. This was back in 2020, 2021 period. And this really all started with me trying to solve my own problems as an investor. And around that time was when we started to get more on-chain data. So some more resources where people like me, who are kind of truth seekers and trying to figure out what's actually going on chain, were able to kind of get some more access to data and information. And we just started sharing that. So we just started sharing that broadly, started on LinkedIn. And that is kind of what led to the DeFi report, which then became a Substack. And we ended up monetizing by providing services with data companies initially in the Web3 space. And now we work with asset managers. We still work with data companies. We just did a partnership with Bankless, which is one of the top media companies in crypto, to help us distribute some of our research as well. Very, very close, very, very focused on what's happening on chain, and then surfacing insights to our audience through that. So that's kind of the DeFi report.
in a nutshell. And question is, how'd you get started, and what makes you the guy? How'd you get hurt, Michael? Why are you a truth seeker? Who
Yeah,
hurt you?
I think the journey here started at MIT, and I was working there at their endowment, and I was working commercial real estate, and we were just kind of lucky to have a small office right on campus. A lot of intellectually curious people at MIT, so it was like more acceptable to talk about Bitcoin at the water cooler. We had a few people in the office that were really into that, and I started to kind of become more interested in it. And this is around 2017. And we also had exposure to just like research that was happening on the academic side. So MIT has a digital currency initiative, they have a Bitcoin club. And so I was becoming interested in, I'm a kind of a naturally curious person. And at that time, if you talked about crypto to anybody outside of MIT, and even friends and family that work in crypto or work in finance, work in technology, they would kind of look at you like you had 10 heads, right, for even taking it seriously.
Mhm.
And so that is really what drove me even further into it, because I knew that these smart people at MIT were taking it seriously. And so that I started to realize that there was potentially a very big asymmetric bet here to be placed. If all these smart people, in my regular life didn't really understand it, but you could understand it through data. So that's really what sparked all of this. And as I said, I kind of went down the rabbit hole, and I just never came out. So that's kind of the story.
So touch on that asymmetric part, or just go into that, because
Yeah.
I agree with you,
Yeah.
and that's what I think is every investor looks for. So
Yeah.
why do you say it's asymmetric?
Yeah, and I still feel this way. Actually, we're now years later here, and I actually still feel this way. But I think for me, it was really just the exercise that I went to try to understand Bitcoin, and at the time, it was really just Bitcoin and Ethereum. And the exercise that I went through was to essentially look at all of the things that people were saying, all of the sort of the naysayers arguments against Bitcoin, that it's only used by criminals. There's no use case. Warren Buffett calls it rat poison squared. There's a laundry list of sort of arguments that people would make. The government's going to ban it. There's a laundry list of things you could look at there, but
And
none of those
didn't
things.
we just have a Harvard guy double down on the
Yeah.
criminal use stance?
Still doubling down, yeah, instead of just admitting that he missed it. Yeah, so there's a laundry list there.
Into that person, who that was.
What's that?
Cue the audience into that story, because our
That was so I forget the guy's name, but he's a Harvard economist. Also wrote a book, I believe. But I think back in 2015 or so, he put $100 price target onto Bitcoin. Obviously it's now 100,000. He posted on X the other day, trying to explain himself and sort of why he missed it, but he basically said that he just didn't think that the regulators or the government was going to allow this to happen, and that the market size for basically criminal activity on blockchains was as big as it is. So he's sort of still attributing crypto just to sort of illicit behavior, which is crazy at this point.
Ken Rogoff, I just looked it up. He and Reinhardt did that famous piece on defaults in 16.
Yeah, this time is different. That's so that was a pretty cool book, conceptually going throughout history and showing how defaults and bubbles lead to wars and debasements. Bad, it was a decent historical book conceptually, and then after they published it, they had to recant the analysis because they had bad data and didn't really control their Excel spreadsheets or whatever they were using.
Bill, I remember that distinctly, because I was a risk manager at the time. I know you sat in that seat, and you're absolutely paranoid about your workflows so that you don't get a hung range or something going on wrong. And then I read further into that aspect. And Michael, this will come back to what you do for a living. And it wasn't that big a deal. It actually didn't take away from their thesis. It might have changed the band of confidence a bit, or the probabilities. It didn't change it. So it distracted, but it just goes to show you how when you publish, you have to be perfect, or you'll lose the stage of credibility. So I commented on his statement, and I didn't say anything about that failure because that was a mistake and their work was okay. I just tore into his argument on the merits. It's factually wrong. There's on everything. So anyway, I love the fact that you were at MIT and that the other guys across the pond are still, begrudgingly buying it, even though they got one of their, tenured former professors and economists poo-pooing it. It's bananas. It's all crazy.
Yeah, I think that was the exercise, and really what became clear to me was that I was doing the work. I was putting in the hours and going really deep, all the way to first principles, to understand, why this thing could gain adoption. And then I would go out and, talk to people and get their opinions, and they would just keep repeating the same stuff. And it was clear that they were just repeating what Warren Buffett said or what someone else said. Or they never actually went under the surface to do any work. And so that's how the conviction built to not only say, okay, this is a investment opportunity, but it's also potentially a business here. There's a lot that could come here if the thesis is right. And when I kind of decided to make this leap to take my career in this direction, the thesis wasn't just for Bitcoin. It was for really public blockchains in general, as a new accounting infrastructure for the internet and for finance. And so that if you kind of can anchor to that, to a thesis like that and why that should be true, then you can kind of look past all the other stuff that's happening with, the wild west of crypto in the early days. And it just sort of looks like any other technology, which typically does get adopted by criminals. I don't think anyone thinks that crypto wasn't used by criminals or still is, but that's par for the course for any new technology. What you want to do is understand from first principles, what could this technology be used for? Does it actually create efficiencies? Does it reduce friction? Does it lower costs? And if you can sort of develop that type of thesis, then you can look through all the other sort of challenges in the early days of the technology. And so that was the process. It's nice to see now that we're finally getting regulation. It seems like everybody is now starting to catch up, and the people that were saying it would just get banned by the government or whatever, now they're reversing and just sort of repeating what other smart people are saying, and just saying, oh yeah, like maybe I don't get it, but it looks like it's here to stay. So it's been an interesting journey over the last 5-6 years. So
when you were at MIT, I know Gensler was there doing the lectures in 18, I believe, right? 2018.
He was. I was there at that time, and never met him. Actually watched every one of those lectures that he did. And I remember when Biden came in and he was chosen to be the SEC chair, I thought that was going to be good for the crypto industry at the time. And I think a lot of people did, because it was clear that he understood the technology. He's teaching it. And we all thought that, okay, this guy understands this stuff. He's gonna help our industry. And it was just the total opposite. So that was very kind of interesting. And I think that's something that you learn a lot about. If you get into crypto at these kind of early stages, you learn so much about not just the technology itself, but how politics play into things, how all these things work. And so it was fascinating just to see how things went during his term as the chair, and also how the court system in the U.S. and the separation of powers actually really mattered, where the courts were able to come in and say, like, why are you still not approving a Bitcoin ETF and things like this? And so just really cool, I think, to see all of that play out, and to see the thesis, come together. Still coming together, but to see the thesis coming together. And now we have a new SEC chair who's looks like he wants to support the industry and wants to move finance on chain. So very exciting time for the industry.
So you've been doing this for a few years, to say the least. What aspects of on-chain data, which is foreign to most people, helps you develop your first principles, so that when someone says something, it's a patent, either misconception or lie, because you have the data, which is a great place to be. So are there any examples that you show where on-chain data was helpful to fortify your opinion?
Yeah, I think, something that a lot of people just missed with Bitcoin and some of these other things is just just purely how many people use these blockchains, and also just how many people care deeply about them, how many people are building businesses around them, how much venture capital is going into this industry. And if you start there and you just look at the adoption numbers, you don't need to like confuse yourself with like intrinsic value and like other things. Like if lots of people care about the thing, then you can kind of anchor to that. And I think the data helps me with that. But I think when you look at something like Ethereum, maybe to sort of pivot towards like an Ethereum here, and you think about what that could be used for as essentially a global accounting system for assets and potentially for other things related to the internet. I think the challenge that people have with understanding from first principles what's going on here is most of us don't think about the internet and how the internet works, but it's basically a maze of private databases that are all trying to speak to each other. And when you think about finance, when you have assets and all the accounting and back office and administrative work that goes into keeping track of everything, you've got a lot of reconciliation. I mean, I did accounting and finance. There's just so much reconciliation. There's so much that goes into that. If you start to think about, well, what if all these assets were on the same accounting ledger, and then you had smart contracts that could program them and automate things, then it becomes very clear why this is a better technology. And then you start to see, okay, this is now actually introducing new business models because it's a new data structure, and you're reducing friction, you're lowering settlement times, and you're cutting out a lot of that back office admin expense. And so if you kind of anchor to that, I think it becomes clear. And I think you have to use these things as well. You need to get into DeFi and play around. One of the like light bulb moments, that I had early on was when I sent myself my first, Bitcoin transaction. You could actually go up to a block explorer and look up your transaction and see it settle in real time. Right. So anyone who's like dealt with accounting or done, you see something like that, it's a light bulb moment, and it gets you thinking a little bit. So I think that's the key thing, is just anchor to the first principles of what's really going on. And then you don't get distracted by the noise and sort of the mainstream narratives out there.
Nice. And,
Yep.
so that's a far cry from when, I started and Bill started in the business, and maybe the, late 80s and 90s is when Louis in the cage had no more than 8 fingers because of all the machines and the paper cutting going on there. And he would take your certificates from another brokerage every morning and distribute them. And you had to make sure that things settled, and that if you shorted stock that you had to borrow, and then you had to talk to Louis, and Louis, maybe he got him, maybe the Brinks truck didn't come.
Yeah.
But that's literally, it was certificates, and then DTC came, and then settlement was T3. So we've been chasing that execution to settlement forever. And obviously, as you just mentioned, payments are still woefully behind everything else on the planet.
Yeah, I mean, I think that's the key thing, is to deeply understand, how these things actually work. And if you go back, I think one of the other things that helped me really kind of develop conviction here is if you go back, like you just mentioned, and you go back to the 70s, what were we doing to do all this accounting? What happened when the internet came about, and how did that impact different business models and new products and all of that? And you can just see that this is like a very clearly moving in the direction of 24/7, 365 trading, lower settlement costs, assets moving onto blockchains where you have a new data structure so that you can self-custody those assets. That obviously, today, if I want to port some assets from Charles Schwab to Robinhood, that's not a click of a button. That it is a click of a button if you're on crypto rails. You're just basically tapping into a new interface with your wallet, and the assets stay with you. So you can start to think about what that means. How is it going to change business models and impact the future of finance? So lot in there, but this is a lot of the stuff that I think about in the direction that we're ultimately going.
So one area that I didn't learn about until I started getting more into crypto was just this concept of Web3. I think you touched on it a little bit with, transactions and the automated settlements and things like that. But can you just give like a very high level explanation for what Web3 and what Web3 is and what it will be in like 10 years?
Yeah, so Web 2 is kind of the ability to that Web 2 is essentially the ability for users to start to write to the internet, right? Web 1 was read only. Web 2 was when we introduced the ability for you or I to comment on Facebook. So now the users can actually engage and you're writing straight to the internet. What Web 3 is introducing is because of this new data structure is read. Now we went from read to read and write to now read, write, and own. And so because of that new data structure, and maybe a simple way for people to think about this is like, if I send you a PDF document on Web 2, I've got the PDF document on my computer. Now you've got it, so we both have it. But with crypto data, if I sent you a PDF document, this could be a token. You've got the token. I don't have it anymore. So that's like giving you $1 in the real world. You've got it. I don't have it anymore. So if you start to think about that and what content can do, so now all of a sudden content can be an asset that could be transferred around. That is kind of how I think Web3 is essentially going to evolve, and it just comes back to, I always want to anchor back to new data structure. Users can control the assets through a wallet, and then what does that mean for basically every single business model on the internet? And so that's kind of how I think of it. When I think of like where we're going with Web3, when you went from sort of when the emergence of the internet, it was kind of like everyone thought you had regular businesses and then you had internet native businesses, and I think the view was that would sort of persist. But if you kind of look back now, everybody's an internet company, right? Even a restaurant has to have a website. And so where this is going, if payments are going on to public blockchains, that means every single website needs to have an ability to take payments via wallets, right? So the whole internet is going to evolve. You have NFTs, right? So Web3 starts to build into, if you're an artist and you want to, create some digital art now, because of the ability for that to be self-custodied, that piece of art could be transacted. It could be sold. And anybody can own that, and you can self-custody that. So I think that's sort of the ultimate direction that Web3 is going, and it really just comes back to this new data structure where users can control data through their wallets. So
nice. I've heard that Web3, is that David Dixon who coined that, or is he a critic with that?
Yes, I forget his first name, but yeah, Dixon, yeah, from A16Z, yep.
At 16Z, yeah. And when I'm talking to people, Michael, I'm always looking for quick hacks to relate what's going on now versus the internet. And it's like owning the internet. Someone's like, "What is this?" And to me, it's Bitcoin and the other chains have almost done a disservice by offering something that no one really understands. It's ownership in a globally distributed ledger, which is absolutely crazy, has never happened before. It's as if Tim Berners-Lee in CERN, what was it, 91, when he birthed that baby, he said, "I have 21 keys in nodes around the world, and I'm just going to auction them off for $1 each and see where it goes." And there are only 21 nodes to the internet ever.
Yeah.
I mean, you're nodding, but
Yeah.
like, Phil, does that make sense at all? It's trying to convert, because I know that you're a recent budding Bitcoin maxi yourself, and and like that internet, owning the internet, owning Bitcoin. Does that make sense at all?
So the microeconomic story was what finally clicked with me in Bitcoin. I actually didn't realize that there was a finite number of Bitcoin that could ever be created. And I was like, oh, okay. So there is demand and there is limited supply. So this is pretty obvious. Like I literally just didn't know that. And it seems like you have a much different story with different cryptos, and we all know that some crypto is junk, and I think that people get confused between like meme coins and, you know, one of my favorite quants of all time, you know, quotes fart coin all the time as his way to disparage all of crypto, including Bitcoin. So um, I think that some of it's almost like opportunistic ignorance, you know, like comparing Bitcoin to fart coin is a ridiculous thing to do. And so there is this microeconomic story for Bitcoin. As long as you believe it's a store of value and that it's safe, it just starts to make more and more sense. And then, yeah, like these quotes about 13 of the last 16 years, and then your 5-year compound annual growth rate. And, you know, like there were a bunch of other statistics that I just didn't appreciate because I was so risk averse. Risk defined as volatility up and down, rather than, you know, kind of focusing on the skew, and you know, the payoff is very nice, and the long-term Bitcoin story makes total sense to me. And then, you know, part of the question about Web3 and all of these other legitimate technologies is just, it seems like that's the inevitable future. You know, like this is the efficient way for transactions to take place, for people to have relative safety, you know, legally with transactions and things like that. So yes, I hope that wasn't too long-winded of a confirmation that yes, that does make sense.
Yeah.
It just, everyone looks at it differently. So Michael, when you're giving your data, when you're looking at your clients, is it an enterprise level product that, you know, you said Bankless, I think you said, uses it? Are they then choosing what you have in order to meet what their audience, or are they using it for their business to drive information directly?
So both. So when we started, we were mostly using off-the-shelf data companies, and we work with these firms. So like the Token Terminal does a really good job. That's the one crypto data app that's actually available in the Bloomberg terminal right now, and they've done a really good job of standardizing a lot of data for people to do financial analysis of these things. We've also worked with companies like Glassnode that focus more on Bitcoin related data, and there's a bunch of them. But as time has gone on, what has happened is we've kind of run into constraints in terms of being able to access stuff that's maybe not just off the shelf with these guys. And so we use Dune Analytics, which is actually more of a platform, and we have you know, data engineers that can use Dune as sort of this like open source platform, and then we can just come up with whatever ideas that we want to start to look at different data, different correlations. And so we offer this as sort of a bespoke data offering for our institutional clients that maybe they've got their own internal research teams, they're coming up with their own ideas, but they just don't have the expertise to actually source that data on chain. And so we fill that gap where, you know, there's kind of a gap between just the off-the-shelf stuff and then the deeper stuff that we can access through Dune. And so that's kind of been the natural progression of this. And we've also done some stuff, you know, modeling some of this data, looking at you know, macro and sort of sentiment related data, liquidity type data, and then you pair that with on-chain data, which gets very interesting because the on-chain data is nearly real time. And so anyone who's trying to deeply understand, you know, what is moving prices and things like that, very interesting to start to look at modeling and quant strategies, systematic strategies, because what's really interesting about on-chain data and fundamental analysis in crypto is the assets essentially reprice in real time based on fundamentals. And I think, you know, we want to talk a little bit about like reflexivity and how that works in crypto. The crypto markets are incredibly reflexive. And what tends to happen, and I think people sort of mistake this, where they think there's a narrative that then drives the price, but oftentimes the price will move, and then the narrative comes after that, and then that actually creates people, that forces people on chain, which then means the fundamentals kick up on chain, which means if you're staking ETH or something, now you're getting more of the on-chain fees coming to you as yield, right? This then drives the price of the token because the fundamentals are improving. So it's just an incredibly reflexive system, and the price of the assets tend to reprice almost in real time based on those fundamentals. So we do a lot of work just trying to deeply understand what drives prices, and help people develop. I think most of our clients just really want to understand, you know, develop a thesis for the asset class so that they can underwrite it, and then just deeply understand what drives these markets.
So we try to be a bit bilingual here. Can you take what on-chain data and make an analog to a credit or equity or currency trader? And the next one is, in those markets, are they reflexive, and if not, why, et cetera? So first, on-chain comps that people.
So on-chain comps in terms of like just how you would do the fundamental analysis, or
What's an example? There's real-time, you know, market value, realized value. You can see holders on chain. You can see transactions. If I'm a credit trader, are they doing the same kind of thing in Trace? I mean, what other sources are there available that are analog to on-chain data, and why is it better or worse?
So I would say the main takeaway there would be that the data is real time, and it's accessible by almost anybody. I mean, you do need expertise to be able to get that data. But I would say what's interesting about this is if you are somebody that just want to cook up a bunch of different ideas, and maybe you want to model some data, you want to access that data, you can get that on chain if you have the right resources. And to me, that's the major piece of this, is you don't necessarily need like a Bloomberg terminal, and it's sort of like accessible by anybody, because public blockchains are, anybody can access them, right? There's no gatekeeper there to access or audit that data. So I think that's the key thing. The data is real time, so that's obviously like very different from what you see in traditional finance.
What
But
were
yeah, I
the
don't know if that answers the
companies
question.
was it the CDS data that 10 banks got together and created their own information company to settle and capture and get all the CDS information, because they knew that the data would be valuable. So that's an example of someone who's centralized, monetizing it, and you got to knock on their door and give money to get it.
Yeah, that's also playing out in crypto, just because of the expertise required to get that data. So these sort of off-the-shelf data companies are providing a service in the market that just makes it easier for people to get access to data. We have this bespoke offering for people that even want to go deeper. But to me, like the data is real time. It's more transparent. In my view, this should make it easier on regulators. Actually, in the future, you can see the buildup of systemic risk. You can see what's happening with active loans and DeFi in real time, how much rehypothecation is occurring, and the systems work. What was interesting is when we had FTX and that whole collapse, that was a centralized entity that was undergoing those challenges, and that created a ton of volatility within the DeFi markets, but they functioned as expected, right? There were plenty of liquidations, but nobody's calling you to tell you that you need to top up the collateral. They're just liquidating, and it worked really well in extremely volatile tested period.
Yep.
And so I think that's another takeaway of just sort of the way that these things can function. But to me, it's the transparency, it's the real-time nature, it's the fact that users can control the data. And I want to be, these markets are still extremely, I would say, inefficient. And so, my thesis has been, that the entire economy is going to ultimately be on public blockchains. And I just want to be close to the data. I want to be an expert. I want to be ahead of the curve. As more assets come on chain, as more stablecoins are adopted, the richness of this on-chain data is going to explode. And we know that data has been valuable throughout time. And so that's kind of my thesis. I just want to be close to this and be able to provide services to others around that. So
cool. We actually have a couple of questions that came in the chat that I'd
Sure.
like to make sure we get to. So there are 2 questions from David. So I'll do them one at a time. What are your thoughts on DeFi? How early are we?
How early are we? So we're still very early because we haven't really moved that many like real world assets. I think you mentioned, Mark, at the beginning, 900 trillion of assets out there. And, Bitcoin's a couple trillion, Ethereum, like we're not even close to where this is ultimately going. And so DeFi is really just like a crypto native kind of degen thing right now. But when you start to bring assets, so there's about 7.5 billion of assets on Ethereum today, which is still a pretty small number. Most of those are treasury bonds. But what I think we're going to start to see here is more assets tokenized. So Coinbase is talking about tokenizing its stock. As an example, is try to kind of get this movement going. Robinhood is going to play a big role here as well. But as you get more bonds, as more equities move on chain, people are going to want to do things with those, and so they're going to go into DeFi. And the sort of next phase of that, I believe, is going to be actually like having maybe more permissioned pools for institutional capital, because you need to be able to understand your counterparties. Everyone needs to be KYC'd within those pools. And so that's kind of the progression I think this is going to take. It needs to start with the assets coming on chain. And then the other piece of that is privacy. So some of the, because these blockchains are open and anybody can access the data, there are solutions coming that can allow asset managers, people that maybe don't want all of their trades being exposed to the market, which is probably like almost everybody, where there's zero knowledge proofs and you can have actually privacy within the public blockchain world. So I think that's the progression, is more assets coming on chain. And I think, that is going to start very soon, especially with regulation coming. And then, maybe more of these permission pools where institutional capital can play in there, and then privacy as well. So it's very early, still very early.
Thank you. Second question, what challenges do you think need to be overcome for institutionals to fully embrace DeFi?
I think what I just mentioned there probably pairs in pretty well with that question. Is they need to be able to understand the nature of their counterparties. They can't be trading with somebody in North Korea. And so everybody who is if you think about a liquidity pool on a decentralized exchange, the way that works today is anybody in the world can deposit liquidity into those pools, and then they earn trading fees when their assets are traded. That structure won't work for institutions, but the actual infrastructure will absolutely work. And so you just need an ability for the institutions to come into a liquidity pool that has been there's a KYC sort of entry point there, and then anybody who owns lots of assets, I believe, will want to tokenize those assets, get them on chain where they can actually provide services. Maybe it's liquidity, maybe it's other asset servicing, where they can then earn fees. And some of the larger, asset managers like the Fidelities have been, doing stuff in crypto since 2015 or so. They're moving, in this direction first. And I think, we'll see others come after.
And on that permission level, say it's Ethereum and they build a layer 2, like Coinbase does without a governance token with Base.
Yeah.
Or JP Morgan's done in a very limited way to settle some repo trades or currency transactions. If you do that and it's KYC'd, that will probably reduce costs for the company and engage clients on it through normal process. Does that in any way, you think, limit the opportunity for the client, or will it just, the market will bear it, whether or not someone finds a less KYC with more options so that they aren't beholden to just trade with that one entity. I'm trying to think of, a global chain like Ethereum, where you can trade stable coins anywhere. If it's a permissioned, like we're doing with Genius Act, does that mean that only US people will do it because someone from Argentina is not going to be, using that bank?
It's a great question. It probably starts in a pretty controlled type of setting, but I think that the demand for this to open up globally and to be able, I don't think it's that useful if, like what you're saying is, you're basically trading with the same people you were trading with before within these pools. I think you want the diversity of assets all over the world and people that can access that. So I think it will evolve, and there's maybe something you guys or your listeners could look into is something called WorldCoin, which is a identity solution for wallets.
Are we tapping into Sam Altman early here, Bill? I think we are.
Yeah.
All right.
But there's, I think, this idea of,
is your eye a virgin, Michael? I need to know.
What's that?
Is your eye is your iris a virgin, or have you been orbed?
I have not. I actually would do this if it was available, and I don't think they've come to New York just yet. They just rolled out in April in the U.S. I wrote about this project. I think it's a really, really interesting project. The iris scan is people have a visceral reaction to this. I think this is going to go away over time, but what World ID allows people to do is, identify yourself as a human. You can then enrich that. That becomes tied into your wallet address through a smart contract, and then you can enrich that with actually who you are, maybe your license data or whatever, and then that follows you everywhere you go on the internet. And now you can prove who you are, but there's zero knowledge proof, and you don't have to actually reveal everything about yourself. And then you can potentially allow others to access your digital footsteps that occurred right now. Everyone is leaving their digital footsteps all over the internet, and Google monetizes that, right?
Yep.
In the future, you could be able to actually own that data and open up the door to apps that want to access your personal data. So I think that's really interesting, and maybe that ties in with making it easier for these more like decentralized pools of capital that want to trade with each other as well to interact. So I think it's going to evolve over time, but it probably starts in a more controlled environment, I think.
And you need to have like iris scans for that sort of functionality?
That is a solution that requires an iris scan as basically tying your wallet address to your biometrics. And I think this is the only way to do this. And it's either somebody like this comes up with a solution, or we have to trust the government to provide that service. And so they're trying to do this in a decentralized way where they don't actually control the access to that. And this gets very technical, so I don't want to go on too far of a tangent here. But it's a solution in a decentralized way to allow people to identify that you're a human, who you are, without revealing, everything about you. It's like when you go to to show your ID at a bar, you reveal not just your age, but where you live and all of that. With this type of solution, somebody could validate that you maybe you need to be a certain age to access an application or to do something. You could basically prove that you're of a certain age or you're from a certain area or who you are without revealing all of your personal details.
Yeah.
So, yeah.
It's a pretty neat process. So on the business front, what is the next? The ETFs were the killer app. How funny, right? The wrapper was the app because we need, it's like a sandwich. We need bread, and we can eat anything between two pieces of bread. Same thing with an ETF. So what is the next thing you think from a adoption standpoint that will move the needle?
So it's happening right now, and it's a lot of these treasury companies. This started with Michael Saylor and MicroStrategy, and it's now moved into Ethereum, and it's also moving into like other longer tail assets, Solana, other assets. And it's kind of a similar thing where you're just taking on-chain yield, and you're kind of putting it in a wrapper so that traditional finance can access that through a brokerage account. And so when I think about these ETH treasury companies, I think they're more interesting than Bitcoin treasury companies because of the fact that ETH has a yield to it. And I think that that's going to be interesting, where the treasury company itself can actually increase the ETH per share for their shareholders. And then they can also take that ETH that they're purchasing, move that into DeFi, and actually generate additional yield if they're skilled at doing that. There's certainly risk that comes into play there, and so you could sort of see more differentiation in terms of how those assets are managed and how investors could look at those things. And then who knows, these companies may evolve into something more than just buying ETH and finding ways to generate yield and increase ETH per share. We could see them offering other services, and they could start to look like financial service companies in the future potentially. But I think that's the big sort of catalyst right now, is you have these companies that are going out there buying lots of ETH. It's driving the price of ETH. Wall Street, I think there was risk in taking crypto seriously, for a long time. And I think at this point, there's risk in ignoring it. And so, you just have a lot of, I think, energy around Ethereum right now because of these ETH treasury companies, what they're doing. And I think that's going to spark the sort of next phase, which is more equity, more assets coming on chain and actually utilizing the actual blockchain rails themselves, instead of just, creating a, publicly traded company out of something that does things on chain.
Yeah, that is a catalyst. I agree, and we know that right now, going back to our title, stop, drop, and roll. That's what a lot of these treasury companies are doing right now. They're hitting their first phase of stall, at least as a group. Now, some have before. To explain it to the crowd, where would you, as a educator and provider of data, where would you direct people to? I'm in the business for almost 4 decades, and I've gone through this and I understand it. And I still have an idea. I'm not sure. I don't see the end game in it, meaning I don't see why the MNAV can't collapse to 1.5. I know there's a flywheel, as people say, and you're creating Bitcoin per share every time you sell it at a premium and a yield. I get that. And then so that's my opinion. But I just mentioned I'm in the game for a while and I'm still asking questions. Where do you think people should, like Sailor's earnings calls from even October of last year when he did the first ATM announcement? Or
yeah, I would say definitely pay attention to those earnings calls. This is not an area that we are like experts in either, to be honest. But I would say that, my view on sort of why these things have historically traded at premiums, MicroStrategy certainly has. It did fall into a discount in the bear market in 22. But the reason I think these things typically trade at premiums is Michael Saylor is attention. He's almost like a meme coin for Bitcoin. He's just everywhere, and he's an evangelist for not only MicroStrategy but also for Bitcoin. And that's a very powerful thing, because the Bitcoin community then supports him and gets behind him, and then they become evangelists for MicroStrategy. So it's kind of an attention game from that perspective. And the market views that asset as a sort of like high beta reflexive play on BTC. And so that becomes sort of a social construct or a narrative, or everyone just believes that to be true. And if you want that type of exposure in crypto and you don't want to do anything on chain, then MicroStrategy is like the only vehicle to get that. And so I think that sort of drives a lot of this. And then we talked about reflexivity, as it's like Michael Saylor will go out on TV, announce that they're raising capital and they're going to buy Bitcoin. And then that generates a lot of activity. People get excited about that. Maybe they front run him. And there's sort of like this reflexive nature to him being able to do that. And then volatility in Bitcoin, the asset itself, which drives volatility of the MicroStrategy stock, which then actually makes those converts more valuable to people. So it makes it easier for him to go out and raise more capital without diluting shareholders. Mm-hmm. And that's sort of what's driving that flywheel a little bit. So it's kind of a odd one to really analyze, I would say, because it's sort of this weird thing where it's like an attention-based thing. And then you've got kind of have this unique aspect where people want access to something with high beta to Bitcoin. And that's like the only vehicle you can get through a brokerage account.
I
So
think it's relevant. It's not that weird because you mentioned early on about converting people or getting people to understand. And for you, for Bill, it was being finite. And then for you, I forgot the word you used about the data structure. You just went to I would say utility. I think you might use another word. And, and then not tangible, but I forgot the other word that people use, intrinsic value, which is the most misunderstood term on the planet. And when people are talking about the dollar bill, about its intrinsic value, which is really not very high.
Right.
The dollar bill itself is a meme.
Right.
And it is an implied trust, whether you call it military power or taxing power, but its intrinsic value is very low. So then in our space and what you're doing, trying to change someone's minds, nearly impossible. You have to find, what's interesting to them, where they are, if that's your game, and you are in the game of selling your business, as I am. So you almost have to dance with what that window of opportunity is, because we all hold on to ideas that are imaginations, and we think that they're real.
I love it. Yeah, no, I love it, because I always, try to tell people that like there's only like a few things that are like certainties, and it's like physics and science, and like literally everything else, which is almost everything that we deal with on a day-to-day basis, is a social construct. And if you think of things that way, then you're not as fixed in how you think about things. And I think this is really important, especially as I go through, as I get older. I want to make sure I'm anchoring to that, so that I'm not sort of viewing the world through like the way I think it should be, instead of just being like observing things as they are. And so, I couldn't agree more. Like, this is sort of maybe a little bit more nuanced in just like how you think and how you view the world. But this is critical to understanding like inflection points with new technologies and sort of where the world is going, I think.
Yeah. Just walk into your closet. I don't know, if you have wide collars or pleats. I got a couple buried back there. It made sense. I thought it was as solid as physics, but it wasn't. It kind of, went the way of the hula hoop. I had to buy new pants.
No, I think that this is like a really key thing. And one of my favorite books actually is it's called Thinking Fast and Slow by Daniel Kahneman. This is like a book that, for me, it's like my favorite book for investing. It's really not about investing, though. It's really about how people think. And it's a really interesting way to challenge sort of the thoughts that you have in your head and why you believe them. And like, it's like this process of sort of unlearning a lot of things that maybe aren't so useful. And it's kind of a book on psychology, but a lot of investors read that book because it really forces you to kind of think outside the box a little bit. And I think this is key, not just for like crypto or investing, but just life in general. And, to your point on like, how do you sort of convey this to maybe an audience that is thinking maybe in a little more fixed way, because we have social constructs that people have been adhering to for so long in terms of valuation, fundamental analysis. I try to bridge the gap a little bit. Like, I try to make it clear that these are different assets. There's different data structure here. There's different fundamentals and KPIs that you want to look at. But the process of developing a framework, of developing a thesis, of actually underwriting something, like, and the fact that, to me, all of these things, there's only one asset that doesn't need cash flow, in my opinion, in crypto, and that's Bitcoin. But in my opinion, everything else is a cash flow asset, and those things are going to be valued based on their cash flows. There's other stuff that may factor in there. But I try to just make sure people know that that's what we're anchoring to. Yes, there's a lot of differences here. And then that allows them to sort of maybe like dip their feet in the water and start to like go a little bit deeper. So
a former employer actually brought Danny Kahneman in to give us a lecture about the book. It's a pretty cool story too, with his former partner who died a long time ago, but the like conversations that they had over decades.
Oh yeah.
Between that's a very cool story. Thank you for bringing that back up too. So we should talk about the opportunities for quantitative research in crypto. In the interest of time, like I know we just can't get into it at an hour. We're at the hour and 5 minute mark, so we should probably wrap up in a few. But can you maybe just speculate a little bit on what the high level like sources of alpha might be in crypto investing?
Yeah. So for me, like the framework that we kind of work off of is we do a lot of macro work in conjunction with deeply understanding what's happening on chain. And so to me, the alpha is in pairing those two things. And then there's also, sentiment type of analysis that we look at. But we use macro data and what's going on, in the business cycle, what's going on with liquidity conditions. And we have a number of data points that we look at there. And we pair that with what we see for Bitcoin. And that's sort of like our cycle awareness in terms of where we're at in the various cycles. And then what gets very interesting is like there's a lot of like trends that you can see in terms of that tell you where you're at in that cycle. And that can inform maybe an inflection point in the market where maybe capital is going to rotate to ETH, which just played out in crypto over the last few months. And we were, lucky to catch that because we've been around for a few cycles now. We have a lot of interesting data that sort of supports these sort of frameworks and theses that we come up with. And so I think that's, for me, it's understanding like how liquidity is shifting around, not just in the greater economy, and then also how that's impacting things in the crypto economy. And, I would say that we don't, crypto can be very like tribal. Like some people just love ETH and they want to say bad things about Bitcoin and the opposite. We are just totally agnostic and we just focus on data. We even do a lot of fundamental, I say we do fundamental research for meme coins because we want to understand what's going on there. Lots of people care about meme coins. What can we learn about meme coins? How are they interacting with, how is capital potentially shifting in and out of meme coins and coming back to L1 assets? We just want to deeply understand how these things work. And so we just kind of let our curiosity run. And then that tends to inform some interesting research and thesis for how we invest. And we really like the sort of concept of a high beta allocation where you have a thesis for the L1 asset maybe. And then there's other fundamental work that can make you realize that maybe I should have a small allocation to the culture coin of that. And there's high beta there. And you can kind of look at the correlations and when capital shifts out to the risk curve. And that's worked very well for us, I think, just anchoring to data and just being really curious in developing our frameworks.
And anchoring to data and not to your own thoughts because you're a disciple of Kahneman and Tversky.
Yes, exactly. That's it. I think that's the key thing. And it's a good reminder, actually, for me to go back and read that. It's a hard book to read. It's a long book.
I did not finish it.
Yeah, it's a painful book to read, but it's just so good. It's so good. So I probably need to revisit it again. Good reminder.
And Michael, just to let you know, my first Substack was based on their 1973 paper that they wrote together.
No kidding.
They brought it out the same month that Marshall Tuckerman wrote "Can't You See?" So
very cool.
I think they're both saying the same thing, but differently.
Yeah, love it. Love to hear that.
Well, Bill, what else? Any other questions? I know someone had a comment about Michael, and that Michael, I think you got to get your face out more often. Someone's calling you a young Robert Redford, so I just want to throw that out there.
All right, maybe I can't. I was going to get my hair cut this week, but maybe I'll have to wait.
I would leave that alone, my friend. I don't know if you're married or unhinged, but just get that game going because
love it.
Yeah, you're running downhill right now after this podcast.
I'm gonna have to come back. You guys just gave me. I don't know if I'm gonna be able to walk out the door here with the way my head's moving here. Got a big ego now.
Good stuff.
Yeah. Awesome.
Yeah, I guess we should wrap it up and give you the opportunity to tell us where to find you. I guess even the business story at the DeFi report, if you want to just elaborate on
Sure.
that a little bit more, I think that would be good for the audience.
Yeah, so most people will know us from our newsletter. So we have a newsletter, about 10,000 subscribers on that, or organically sourced. We started on LinkedIn, so we have most of the institutions that are doing stuff in crypto that read our research, and it's a combination of hedge funds, venture capital, professional investors, folks that work in Web3 at some of these larger institutions, and then we also have just people that work in Web3 and in crypto. What's interesting about this industry is like almost everybody who works in the industry is like an investor as well. So lots of people follow the research from that angle. And that is kind of like how people know about us. And then we have a product called TDR Pro that just gives people a little bit deeper insight into portfolio management. We go a little bit deeper for our pro members with some of the macro and cycle awareness type updates. That's a $25 a month product. Very, very simple, easy product to plug into. And we partner with Bankless for distribution on that. So Bankless is the largest crypto podcast out there, mostly sit on our retail audience. And so we do a monthly podcast where we surface like some of our best research for the month, and we go on there to share that. And then the consulting side of the business is really like working with asset managers, so family offices, different types of asset managers that want to deeply understand this from not just like, what is it and why should I care about it, but like, how can I develop a framework to deeply understand this and underwrite this opportunity? And a lot of this is working with like an analyst team so that they can go to their boss and say, here, this we have I've got an actual model, or I've got an investment thesis that makes sense. And so we help people with that. And then if they want data to support some of that for their internal efforts, we have engineers on our team that can surface insights from on-chain as well. And so that's kind of the full suite. We've been around for a little over 4 years now, and we're just starting to kind of it was mostly kind of me running things for a long time. We're just starting to expand the team a little bit now and grow. So it's fun to always come on here and talk with you guys, and maybe we'll have to do it again sometime.
Yeah.
Yep.
Bill, can I ask one more question before we sign off here, Michael?
You can. Yeah.
All right. A little inside baseball. Michael, Bo Hines announced yesterday that he's going to Tether. So he's, is that going from the miners in the presidential administration of the United States to the majors, going to El Salvador to the largest stablecoin provider? Or like,
so that is interesting. Yeah, that is very interesting. I didn't know about that. So, this is interesting. You got the wheels turning a little bit, because I think Tether is potentially going to end up becoming like very, very close with the US government, because they are sort of the mechanism to grow the network effect of the dollar in emerging markets. And they were the 5th largest buyer of US Treasuries. So obviously, if you're the 5th largest buyer of US Treasuries, you think the government probably wants to be friends with you. And so that's very interesting. I've been trying to think about where this is ultimately going, because I view Tether as sort of like it's like the stablecoins are kind of like the new petrodollar system, in some ways. And so
in some ways, I think even better.
Yeah, I agree. And so, I really think that what stablecoins are going to ultimately do is greatly enhance the network effect of the dollar, provide, decentralize the holder base of, US debt as well. I mean, in some ways you're concentrating it into these issuers, but the holders of the coins are actually, decentralized versus, just one country. So that's very interesting that happened, because that kind of confirms some of my thinking on this.
Yeah. And then I guess the only question is, was it approved? In other words, was he pushed or pulled in? That's the part. I wonder if it was a agreed upon trade.
Yeah.
I would think, now that you're talking, I didn't think it was. I think it had to be an agreed upon trade by both sides.
Yeah, it sounds like it. It sounds like it probably was.
Yeah.
And it'd be interesting to
Wow.
see who has the leverage on those in those talks.
Yeah.
Tether probably has a lot more than people realize. So that's interesting. Well, this has been great, guys.
Appreciate it, Michael.
Yeah.
Load of fun chat. We'd love to have you back on.
Sounds great. Great to see you guys.
You too.
Thank you.
Thanks, Bill.
All right, we are off of YouTube.
Okay.
And
All right.
I'll go ahead and stop